Assalamualaikum. We are from Group 3 and today we would like to present our topic on DFD and the revenue cycle.
Assalamualaikum warahmatullahi wabarakatuh. Today I will present the data flow diagram or DFD for the production system of Yesa Textile Sdn Bhd. This DFD explains how information flows throughout the production process, from receiving customer orders until the finished goods are stored in the warehouse. The process starts with the process 1.0 master production schedule, which is MPS. The sales department sends the customer order information while the system also checks the inventory file to identify the available stock. Based on this information, the production schedule is prepared and stored in the master production file. Next, in process 2.0, the system prepares the bills of materials, which is BOM, which lists all the materials needed for the production. This information is then stored in the bills of material file. After that, process 3.0 prepare 3 copies of material requisition, which is MR. The MR is sent to the purchasing department to purchase any missing materials and to the store department to prepare the available materials. It is also sent to the material requisition file. Once the materials are ready, the process 4.0 begins the production. The store department transfers the materials and the production process starts. In process 5.0, the system prepares the job time ticket, which is JTT, which is sent to the accounting department to record labor costs. Finally, in the process 6.0 is the packing stage. The finished goods are packed and transferred to the warehouse for storage. In conclusion, this DFD shows how Yesa Textile Sdn Bhd manage its production process in a systematic way, ensuring that every department receives the information needed to complete the production efficiently.
We now move to the revenue cycle. Let me begin with what is sales order entry actually is. Sales order entry is the first step in the revenue cycle before any goods leave the warehouse, before any invoice is sent. It all starts here. This is the process where a company receives and processes customer orders. Traditionally, this was handled entirely by the sales department, but today, companies increasingly allow customers to enter their own orders directly through a company website, reducing manual work and cutting costs. So, what happens when an order comes in? Every order is recorded on sales order document, which today usually in an electronic form. The document captures the item numbers, quantities, price and terms of the sale. Orders can arrive in 3 main ways: through sales staff who enter them manually, through website form that customers fill out themselves, or through EDI, electronic data interchange, where customer system automatically send the order in format the company system can read directly. Beyond just receiving orders, IT also help increase sales. Retailers like Amazon use past purchase history to suggest related products. Companies also send personalized coupons to encourage repeat purchases. Some even offer interactive order system where customers can customize products to their exact needs. This build-to-order approach also improves cash flow. Less money is tied up in finishing goods inventory and companies can collect payment in advance before they even pay for the raw materials. Once the order is taken, the next question is, can this customer actually pay? Since most business-to-business sales are made on credit, every order needs to go through a credit check before it's approved. For existing customer in good standing, this is straightforward. The system automatically checks whether the order will push their balance over their credit limit. If it doesn't, the order is approved instantly without human involvement. But for new customer or for order that will exceed the credit limit, a credit manager will step in and specifically approve the extension of credit. By keeping the credit manager independent on the sales function, the company protects itself from bad debt. After the sale, management uses an account receivable aging report, which lists customer balance by how long they have been outstanding to monitor who is paying on time and who is falling behind. This allowed the company to act early and minimize losses. The third step answers a simple but critical question. Do we actually have the goods to fulfill this order? Before confirming any order, the system checks the quantity on hand, the quantity already committed to other customers, and the quantity actually available. If there's enough stock, the sales move forward. The system reduces the available inventory count, notifies the shipping and billing departments, and generates a picking ticket, a document that tells the warehouse exactly which item to pull and in what quantities. Importantly, the picking ticket lists item in warehouse sequence, not the order they appear on sales order, so warehouse staff can move efficiently through shelves without backtracking. If there's not enough stock, a back order is created. In a manufacturing company, this triggers the production department to start making the items. In a retail company, it notifies purchasing to go out and buy them.
The second activity in the revenue cycle is shipping. The shipping process is when a business actually delivers what a customer bought. It starts when a warehouse worker gets a digital shopping list called a picking ticket to find and scan the items on the shelves. They bring the items to the loading dock where another worker double checks everything against the original order to make sure it is correct. This second worker packs the box, adds a checklist for the customer called a packing slips, and creates a legal contract for the delivery driver called a bill of lading. To prevent theft and cheating, companies make sure the people who handle the physical inventory are completely different from the people who handle the paperwork and billing. The exact moment the delivery truck drives away with the goods, the computer system automatically subtracts those items from the warehouse stock, updates the product cost, and tells the accounting department to send the customer their official bill.
Now, I will explain the third activity in the revenue cycle, which is billing. Once the warehouse has shipped the goods to the customer, the billing department will prepare an invoice. An invoice is simply a document that tells the customer how much they need to pay for the goods that they receive. Before sending the invoice, the billing department should check the sales order and the shipping documents to make sure that everything is correct. After that, the invoice is sent to the customer and the amount owed is recorded in the account receivable. In short, billing is important because it ensures that the customer is charged to the correct amount and helps the company to record its revenue accurately.
Next, I will explain about cash collection. Cash collection is the final activity in the revenue cycle. Cash collection is the process of receiving and recording payments from customer for goods or service provided. It involves collecting payments through various methods such as cash, check, bank transfer, or electronic payments. It also verifies the amount received against outstanding invoice, recording the receipts in the accounting system, updating accounts receivable balance, and depositing the collections into the bank. For example, at Zozo Sdn Berhad, customer makes payment to the company after receiving the goods and invoice. Rahma, the billing officer, receives the customer payment, verifies the payments by comparing the invoice with the sale orders, and updates the account receivable records accordingly. This completes the cash collection activity in the company's revenue cycle by ensuring customer payments are recorded and reflected in the account receivable ledger.
Now, let's look at the first weakness found in the company's revenue cycles. So, in this company, the sales clerk manually assigns the sales order numbers instead of using pre-numbered documents. Imagine if every employee creates their own numbering, some numbers might be skipped, repeated, or even changed without anyone noticing it. So, as a result, sales order could be lost, duplicated, or altered, making it difficult for the company to keep complete and accurate records. So to solve this problem, the company should use pre-numbered sales order that are generated automatically by the system. The company should also regularly check the sequence of the document's number to make sure that no documents are missing. So this will help improve the accuracy, reduce error, and strengthen the company's internal control.
The second weakness is lack of authorization and inventory check before processing orders. If we ship out orders without checking our warehouse first, we risk running out of stock, which leads to back orders and really unhappy customers. At the same time, if we don't check a customer's credit before processing their order, we risk selling to people who won't pay us back. That leads to bad debts and lost money. To fix these problems, we need to set up 2 strict rules, which is the first one is always systematically check our inventory levels before we confirm any order, and second one is establish a formal credit approval process. It is super important that this credit check is done by a separate credit manager who is completely independent of the sales team, because while sales want to sell to everyone, the credit manager makes sure we actually get paid.
Next, we will look at the third weakness, which is that the sales clerk verbally instruct the warehouse keeper to issue goods instead of using a written document. For example, if a customer orders 20 ergonomic chairs, the sales clerk may simply tell the warehouse staff, please prepare and ship 20 chairs for customer A. Because of the instruction is only verbal, the warehouse staff might misunderstand and release 30 chairs instead, or even the wrong type of chairs. This can lead to the theft, loss of inventory, and the shipment of incorrect goods. To overcome this weakness, the warehouse should only issue goods after receiving an authorized written document, such as goods issued notes or a picking list. This ensures that all goods are properly authorized before being released and help reduce error and frauds.
The fourth and perhaps most critical weakness is the concentration of incompatible duties in a single individual. In this case, Rahmah, the billing officer, is responsible for both receiving customer payments and maintaining the account receivable records. This complete lack of segregation of duties creates a high risk of fraud and embezzlement. Rahmah has the ability to manipulate accounting records because she updates the account receivable and ledger herself. She could easily alter or adjust entries to hide any missing payments or unauthorized transactions, making it very difficult for the company to detect any wrongdoing. Since the process has not been formally reviewed for several years, any ongoing irregularities may have gone undetected. The corrective action to mitigate this risk, the company must immediately segregate these two functions by assessing cash collection responsibility to one employee and accounts receivable record updates to a separate independent person. The company should also perform regular reviews on each account. A supervisor or internal auditor should periodically reconcile the accounts receivable records against actual cash collections and bank statement. This provides an additional layer of oversight and helps detect any discrepancy or irregularities in a timely manner. This ensures that no single individual has unchecked control over both assets and records.
Lastly, the weakness is that the billing officer verifies payment by only comparing the sales order and invoice without reviewing the shipping documents. The risk here is quite serious. Customer may end up being billed for goods that were never actually shipped or for incorrect quantities, because there is no proper confirmation from the shipping documents. As a result, the accounts receivable records may not reflect what really happened in the delivery process, which can lead to financial misstatements and customer disputes. To put it simply, imagine a customer orders 100 units but only 18 units are actually delivered. If the billing officer only looks at the sale order and invoice, the system might still charge the customer for a full 100 units. The customer will obviously question the bill and the company's records will no longer be trustworthy. So to address this issue, the billing officer should perform three-way matching by comparing the sales order, shipping document, and invoice before recording customer payments and updating the accounts receivable records. This ensures that the customers are only billed for goods that have actually been shipped and in the correct quantities, improving the accuracy and reliability of the company's financial records.